A chill is sweeping through the American job market, and it's not just the autumn air. In October 2025, a number that sent a tremor through the financial world was announced: over 153,000 job cuts. This wasn't just a bad month. It was the worst October for American workers since 2003. A stark warning that something fundamental is shifting beneath the surface of the economy. At the heart of this tectonic change is a force that promises a future of unparalleled efficiency, yet threatens to leave millions behind in its wake. Artificial intelligence. The data, compiled by the employment firm Challenger, Gray and Christmas, paints a grim picture. The technology sector, once the engine of seemingly unstoppable job creation, became the epicenter of the layoffs. In a single month, tech companies eliminated over 33,000 positions, staggering five-fold increase from the month before. It's a paradox of our times. The very industry building the future is also dismantling the present workforce at an alarming rate. Enterprises across the board are tightening their payrolls, citing a toxic cocktail of weak consumer demand, the prolonged agony of high financial costs, and a powerful new incentive to replace human labor with automation and AI. This isn't just a cyclical downturn. It's a structural rewiring of the economy, and the casualties are piling up. The layoffs in October were not an isolated event, but the culmination of a troubling trend. According to Challenger, Gray and Christmas, the total number of layoff announcements since the beginning of 2025 has already surpassed 1 million. This represents a dramatic surge compared to the same period in 2024, reflecting a confluence of cyclical economic headwinds and the irreversible structural impact of AI and automation. The names on the layoff announcements are a who's who of corporate America. Giants like Amazon, Target, Paramount, Molson, Coors, and Starbucks are all in the midst of deep restructuring. They are not just trimming fat. They are fundamentally re-engineering their operations, optimizing workflows with technology, and making drastic cuts to office and operational staff who were once considered the backbone of their businesses. Amazon, a bellwether for both retail and technology, has openly forecasted further staff reductions following the extensive deployment of AI across its logistics and corporate divisions. Similarly, UPS announced workforce cuts not because of a lack of business, but because automation has boosted productivity to the point where fewer human hands are needed. The financial markets, ever sensitive to the faintest economic tremors, reacted with predictable anxiety. Tech stocks, which had soared on the promise of AI-driven profits, began to weaken. Investors grew wary of sky-high valuations and what the poor labor data signaled about future consumer spending. A mood of heightened caution has descended upon Wall Street, as the very technology that was supposed to guarantee future earnings is now seen as a source of instability. The timeline of this unraveling was swift. As early as September 2025, the pace of layoffs began to accelerate. With many large corporations initiating cuts to their office, staff a sign that the pain was moving beyond the factory floor and into the white-collar world. Then came October. The announcement of 153,074 planned cuts was nearly triple the figure from October 2024. A historical spike that set off alarm bells. Within that figure, the tech sector's purge of over 33,000 jobs stood out as a particularly ominous sign. Simultaneously, hiring intentions plummeted. New hiring plans announced by companies fell to their lowest level since 2011. Plans for seasonal holiday hiring were the weakest since CGC began tracking the data in 2012, casting a long shadow over the upcoming retail season. While the official data painted a bleak picture, other sources offered a more nuanced, though still concerning, view. Private data from firms like ADP and Revelio Labs showed that while hiring demand was cooling, it had not collapsed entirely. This discrepancy has put the Federal Reserve in a difficult position. The central bank has publicly warned about the need for caution in assessing the labor market, especially with potential disruptions in official data collection. The Fed faces the risk of misdirected monetary policy. If they misinterpret the trends, they could either choke off a fragile recovery or let inflation reignite. The stakes could not be higher. The impact of this wave of layoffs is not just cyclical. It points to a profound and potentially permanent structural shift in the labor market. The jobs most at risk are those involving administrative tasks, back-office functions, and repetitive operations, precisely the areas where AI and automation excel. While there is a surging demand for new skills in AI, machine learning, data science, and process automation, this demand is not materializing fast enough to offset the sheer volume of jobs being eliminated. There is a growing skills gap, a chasm between the workforce of yesterday and the needs of the automated enterprise of tomorrow. In this high interest rate environment, businesses are locked in a desperate battle to preserve their profit margins. Faced with slowing consumer spending, they are making a strategic choice: prioritize investments in technology and aggressively cut labor costs. This creates a vicious cycle. The cuts reduce household incomes, which further dampen spending, giving businesses even more reason to cut costs. The weakness in seasonal hiring is a direct spillover from this corporate strategy, painting a darker outlook for the remainder of 2025 and beyond. For the market, this raises serious risks. The pressure on tech stocks could intensify amid concerns of a valuation bubble and uncertainty about future earnings. Volatility is likely to persist as long as the labor data continues to show signs of weakness. This complex situation leaves policymakers, particularly the Federal Reserve, walking a tightrope. They are caught between their dual mandates of supporting economic growth and controlling inflation. The path forward is unclear. Any decision to cut interest rates will be heavily dependent on clearer, more definitive evidence that the labor market is not just cooling, but weakening in a material way. A premature move could be disastrous, but waiting too long could plunge the economy into a deep recession. Andy Challenger, Senior Vice President of Challenger, Gray and Christmas, offered a sobering expert perspective on the data. The widespread adoption of AI, coupled with slowing consumer spending and rising costs, is creating a much more difficult environment for job seekers, he explained. Companies are not just cutting jobs, they are fundamentally rethinking the need for certain roles. This makes it harder for displaced workers to find new positions as quickly as they did in the past. His analysis underscores that this is not a temporary storm, but a climate change event for the American workforce. The prevailing view among market analysts echoes this sentiment. The current wave of layoffs is not merely about short-term cost-cutting to weather an economic downturn. It represents a deeper, technology-driven restructuring aimed at boosting long-term productivity. We are witnessing a historic transfer of power from labor to machines, from human capital to artificial intelligence. In the post-AI era, the very definition of work is being rewritten, and the social and economic consequences of this transition are only just beginning to unfold. The empty offices and the staggering layoff numbers of October 2025 are not just data points on a chart. They are the opening scenes of a new chapter in our economic history, one whose final pages have yet to be written.